Today's webinar topic is your 401k plan right for you? Before we get started, however, I want to cover a few housekeeping items. If you're having any technical difficulties, please call us in our office at 1-800-700-0089, or you may submit a request for assistance via the Go-To Meetings box on your Go-To Meeting Control Panel. If you do have questions during the presentation, please submit them via the questions box. If we're not able to answer them, we will provide an answer to you via the email after the presentation is over. Before we get started, however, I did want to say that we actually gave this presentation last week during a lunch and learn, and so we're going to go ahead and do a more exhaustive or extensive version of this. So it's going to take maybe a little bit more like 35 minutes today rather than the usual 25 minutes. So we may go a few minutes over than usual. So today we're going to go ahead and cover the good, the bad, and the ugly in terms of 401k plans, 401k basics. Not going to spend a lot of time on this, but how they work, contributions and value, some common mistakes that are made with 401ks, and then really get into the meat of the presentation. This is pretty unique. We haven't seen this out there, but it's really age-based recommendations for your 401k. And at the end, we're going to wrap it up with a planning tips about whether your 401k plan is right for you. Some thoughts to think about and to check on to evaluate your own 401k. But with that in mind, in terms of questions, if you do have questions, please submit them via the Go-To Meetings Control Panel. We will try to answer them at the end of the presentation. All right, I'm going to turn it over to Rohan at this point.
Hey, thank you, Laurent. Before we jump into the details of the presentation, I just wanted to share some interesting stats we saw with the sources listed there at the bottom of the slide on 401ks, kind of the good, the bad, and the ugly. So the good, you know, the average 401k in the U.S. has just about doubled since 2008 until 2013. Another good stat we saw was the average savings rate to 401ks was 7.34% of an individual's pay. That is what we like to see as planners. That's what everyone likes to see. The bad news, with the economy recovering, especially in today's day and age, people tend to move around in their career and change jobs more frequently. Just last year in 2013, 35% of those people who moved or changed jobs cashed out their 401k plans when they left their jobs. Now this rate's even higher for Generation X and Generation Y, which is comprised of ages 20 to 39. Naturally, this age group is more likely to switch jobs. But it does get uglier. Now let's look at the ugly. The 35% of plans that did get cashed out got hit really hard. The average account netted $11,000 after penalties and taxes. So an average account of $16,000 was cashed out after getting hit with penalties and taxes. What was left over was about $11,200. Directly, what this means is it's a loss of $461 of monthly income in retirement. And losing about $500 a month in retirement, that's substantial. And this comes directly from the mistake of cashing out your 401k, what we consider is equivalent of an investment suicide. So don't do it.
That's a really interesting point. I'll just point out that $16,000 was set up for a 30-year-old or approximately a 30-year-old, and so the amount of time between then and retirement at 65 was a pretty substantial and healthy, 30 to 35 years. So you may be wondering how you can get $500 a month from that 16K, and it all comes from essentially compounding and really a nice diversified portfolio. So just a couple of comments on that. I'm going to continue to talk about, again, employer retirement plans. The focus of today's presentation is 401k. However, with that said, there are actually quite a few other plans that are very, very similar to 401k plans in terms of their characteristics, their savings ability, for a different segment of folks that are in public positions such as teachers, nurses, and hospitals. Certainly, and those are 403B plans for those folks. 457 plans are offered for police officers and other local government workers, and there are something called thrift savings plans, or TSP plans, for federal workers and military. So those plans are very, very similar to 401ks and really have a lot in common with what we're going to be talking about today. However, there are some plans for the self-employed. Some of them are quite different. Some of them, one of them in particular, is identical. It's the individual 401k or solo 401k. So whatever I'm talking about, the individual or solo 401k, where you are both the employer and the employee, what I'm talking about today does follow. And then, of course, there are some plans that are dissimilar or not similar. Those are SEP IRAs and simple IRAs, and we will not be talking about those today, but if you do have questions about that, please feel free to email us, and we're certainly happy to answer those questions on those retirement plans. All right. A little bit of, Rohan talked about a few metrics. I'm going to continue along that line, a bit of history on what's occurred in the last 30 years to the traditional pension plan. Again, pension plans are those types of plans that for our parents or grandparents provided a stream of income for life for that segment of society. And again, if we take a look at what happened in 30 years, in 1985, about 89% of the Fortune 100 companies in the United States offered defined benefit plans or pension plans. Today, or really up until 2 years ago, 2012, only about 10% of Fortune 100 offered those plans. So what's really replaced the defined benefit or pension plan? It's really the 401k and similar, which are called defined contribution plans or employer retirement plans. So today, about 65% of private employers offer these plans, and then as I mentioned, the majority of local, federal, and teacher organizations also offer similar plans, although they're called something slightly different. The good news is that many firms do contribute a portion of their profits or earnings to the individuals in these plans, and in 2012, really interesting statistic, average about 4.5% of a worker's annual pay. So that was good news then. This next slide really is the value of contributions. Again, very quick overview. I'm sure everybody that's listening today really does understand the value of these plans, but I'll cover it real quickly. It is one of the best and easiest ways to accumulate wealth for retirement today. Again, for those folks that have access to it, you really should be considering it strongly. We see clients come in all the time, and if they've done a really nice job of contributing to their 401k and they're planning on retiring it at say in their mid-60s, they're really set up in much better situation for retirement than those folks that come in that really haven't maybe done as good a job on their 401k savings. And in terms of why is it the best and the easiest? Well, putting money into a 401k is both tax deductible and tax deferred. And by what I mean by that is that every dollar that you put in from your salary every month essentially goes in without being taxed. So it's really pre-tax money that you're putting into that account, and that money grows really tax deferred, meaning all gains in that account, income, dividends, all of that is really deferred in terms of taxes until you actually get ready to take it out. And only when you take it out of the plan is it actually taxed. There are automatic monthly deferrals and automatic participation, which is one of the great focuses of this. And then again, one of the last points we make is that many firms do offer an employer match, i.e. it's considered free money. An example of that would be, for example, 50-cent match for every dollar contributed up to 10% of your base salary. So those are some of the values. In terms of common mistakes, certainly I think the first of these are pretty familiar, not starting early enough and missing out on your employer match. And in fact, I did read one article recently which talked about a 25-year-old that began contributing $100 per paycheck essentially versus, say, an individual at 35 that started 10 years later. And what happened is that 35-year-old, even though they contributed much more during their lifetime, all the way up until 65, they actually weren't able to catch up to that early saver. Why? It's really the eighth wonder of the world, per Albert Einstein, and really the power of compounding is the reason. Couple more mistakes. Again, Rohan talked about investment suicide, cashing out your 401k when changing jobs. We really recommend not doing that. There is a loan factor or loan option for most 401k plans. You can take up to 50% or $50,000 out. as a loan from your 401k plan, whichever is less. We don't usually recommend that to our clients because it does shortchange yourself. And then lastly, speaking of shortchanging, really for those folks that have lots of different competing goals for their savings, a lot of times it's kind of easy to maybe not put as much into your 401k and really pay for vacations and other kinds of things during your lifetime. So we'll talk a little bit about that in the cases that we're doing. So with that, I'm actually going to turn it back over to Rohan to talk about how we're going to present the different case studies.
Sure. So just to give you a better understanding of the investment strategies and tips for 401k investing, we'll walk you through case studies broken down by different age groups. We do strongly believe that these strategies vary based on which phase of life you're in. So you can see on the table here, starting with the accumulation years, this is kind of the younger years or the early years for people or couples or individuals between ages 22 and 40. But this is when people usually first start out in their careers and start making good income. Maybe it's after college or once they get their first career job where they have disposable income to store away in all different sorts of savings vehicles. Then there's the mid-years, age range from 41 to 55. These are the stronger years in terms of your career, your income, when you start accumulating your wealth. And these are also the years where you start forming habits in terms of spending and what your lifestyle will be like going forward. And there's the later years where age range between 56 and 70, where you really have to focus on your investment portfolio, build that retirement plan, and have a strategy in place that leads you towards a perceived retirement that you want. So let's look at the first case study. This is for the early years, age range 22 to 40. And this case studies are based on actual Bell clients. We're using fictitious names and numbers here, figures here, just to make it easier for the examples we talk about. But we really want to use live examples from our client base. So here's a married couple, Mark, age 37, Mary, 35. They have a daughter, age 2, Jamie. They're spending about $70,000 a year purely on living expenses. It excludes taxes. You can see taxes are separate for $46,000 a year. And the current income, healthy income, Mark makes $100,000 a year, Mary makes $50,000 a year. And they came to us with certain goals in mind. And those are three listed there. That's what they told us. We really want to buy a home in 2018. It's coming up. They want to fund their daughter's education. And the last goal is retirement. So we took that, we built a plan for them, and what we did was created a savings distribution strategy. From the numbers we saw that they have about $27,000 a year to disperse in different savings vehicles. We did an evaluation to see what the most important priorities and goals are for them that are coming up. And the most important one was the home purchase. As you can see, a large chunk of the saving goes towards that category where they will allow them to kind of build that reserve and put it to use coming 2018 ready to purchase that home. And the rest of the savings goes towards Mark's 401k, Mary's 401k, and also the Roth IRA contributions, which I'll talk about a little bit later, what significant difference they make in the long term towards retirement. So we built kind of a tips slide here for people in that age range in the early years, and we get all kinds of questions from that group in terms of how much should we be spending or saving. Here's a kind of a guideline. You should be spending about, people tend to spend or should be spending about 70% of their income, saving about 20% of the income, 5% going towards building the emergency reserve, and another 5% towards gifts and charity. Laurent kind of talked about having an automatic deferral from his salary. It really helps, especially during this age, to have those automatic savings placed from your paycheck where you don't notice the savings you're making, and you kind of build a habit of saving and spending the right amount. We strongly recommend any couple, any planning couple that comes to us, we strongly recommend they have a 6-month of living expense stored away in a savings account. And this is especially important for a younger couple, or when you're in this age range where you start building this emergency reserve. Because as you go, now you're in the early years, you go into the mid years, you already want that to be in place as your fallback or a rainy day fund. That way you can focus on your other goals in terms of retirement and other taxable goals. Another consideration here is a contribution to the Roth IRA. We really feel contribution to a Roth IRA during your early years is very, very important, just because this is the only vehicle out there where you can contribute after-tax dollars, have it grow tax-free, and even when you pull from this account in your retirement or later on in life, you're not getting taxed on it. We do have some 401k tips for this age range as well. First of all, start early as possible, even if it's doing $50 a month, $100 a month, little as possible. It helps in the long term. Because you have the time horizon of 20, 25, 30 years ahead of you, we strongly do recommend you invest higher percentage in growth assets. This really helps kind of face the volatility of the market ups and downs, and still recover because you have a time horizon, which gives you a higher chance of getting higher returns on your investments. But while you do that, it's really important to diversify your investments. We get a lot of clients who work for a company and are heavily invested through their 401k and other retirement accounts, holding the company's stock as much as 50, 60, 70% of their retirement savings. We would really recommend to really diversify your assets, explore other options, do the research, and the very last point there is contribute at least the very minimum to get that employer match, even in the years where you feel like you're not able to. We have some planning tips here throughout the presentation in terms of what you should do in certain situations. We kind of touched on changing jobs within your life and your career. Here are some tips here, and you can see the top three are smileys, which means things you should be doing or you can do, the good options, and there's the okay options, and then there's the bad options in a way. So the top three are interchangeable. You can, when you do change your jobs, you can leave your 401k, your job as it is. You can move it to your new firm, or you can roll it over into an IRA. And all these depend on different options in terms of the flexibility, investment options. And before you make that decision to either move that 401k into IRA or to a new firm, we strongly recommend you speak with your financial advisor or a CFP before making a decision on this change. The okay option here, which we do see as beneficial, is converting that 401k to a Roth IRA. But this does have tax consequences, so do check with your CPA or tax advisor first. And the very last option there, which has a big sad face on that bullet point, is taking a lump sum distribution from your 401k. We talked about that. It has very long-term effects that you can't see now, but for us, it's a definite no. Don't do it. There's other options out there.
Great. Well, thanks, Rohan. We're going to move forward to talk about the case study in the middle years. So again, go ahead and we're going to take a look at the middle years from age 41 to age 55. So in this particular situation, we had a couple that came to us a couple years ago. They're married, Alan age 52 and Elaine age 51. They're obviously not their real names, but they had two daughters, close to teenage, or at least the oldest one is 15 and 10 2 years ago, now 17 and 12. Current income $280K, living expenses $150K, and then again federal and state taxes taking a fairly big chunk out of that of $72K. They had some financial goals. The number one being retirement. Number two being college for Erica and Amy. Number three, new car, and then four, travel now and in retirement. And but for them, because it's the middle years, retirement really was a priority for them. So they came to us and again asked us for some recommendations, take a look at their 401k plans, figure out are they putting enough into 401ks, et cetera, and really evaluate their 401k plans versus others. So for them, we came up with the following recommendation. They have about 58K of savings, which is about 20% of their overall income. And for them, it was really important for us to move more into their 401k plans. So they're both putting in the max, since they're both over age 50. They're both able to put $23,000 into those plans, and then less, if you will, into other goals. So it's a competition for capital. So a small amount for college savings for Amy, and then they still wanted to continue their charitable giving. So we're recommending that they have 8K for that. As you take a look at tips for the middle years, I talked about this competition for capital, and you really have to try balancing the spending, saving, gifting, and ongoing expenses. It's very, very difficult to do, and there's definitely a tendency to move basically money out of your and not contribute to your 401k and really putting into these other areas. So we work with our clients very frequently to try to help them prioritize this and figure out, again, where their 401k fits into this picture. Secondly, I always talk about the emergency reserves, so it's very, very important. And for this couple, we recommended that they work to set a goal of 6 to 9 months of living expenses, and they were not doing such a good job in this area, so they really I suggested that they make this a goal. And then lastly, maxing out the 401k salary based on your age, very important. 17,500 if you're under age 50, 23,000 a year with the catch-up age 50 or over. And then one last slide, sorry about that, before we move on to the next case study, which is we often find that 401ks in this situation are either leftover or there's smaller 401ks out there or orphan 401ks, and so it's important to maybe try to consolidate and manage those more actively. Certainly investing a higher percentage in growth assets makes sense at this point, given that they still have, again, quite a few years to go before they retire, but it might make sense to maybe adding some fixed income to smooth out some of that market volatility here. And then diversifying investments is really important, as Rohan mentioned earlier. And then a goal is, it's expensive in the Bay Area, so I recognize that saving 20% is perhaps a high goal, but certainly saving 10% is really important, given the 401ks really are the predominant vehicle for savings in today's corporate and public world. Moving on to our third and last case study, the later years, you'll see that the folks in this category have reached age 56 to 70. It's really important that they begin to kind of focus on retirement and what that looks like. In this particular example, again, not the real names, but we had Greg, age 66, and Susie, age 62, come to us for some planning advice. They had 2 children, 4 grandchildren. They currently made about 200K. But that number is actually, that salary is going to be going down because one of them or both are going to be retiring soon, and their living expenses are at 100K a year, so taxes in this situation about 50. Their financial goals were retirement, and that very, very important to make sure that they had enough for retirement, and then secondary goals, including college gifting for their grandchildren and some travel and some charity. So for this couple and family, we recommended that they still continue very strongly with their 401k. They've only got a few years left, so it's important to really try to set up their retirement as strongly as possible. In this situation, Susie actually was a teacher, so you'll see there in the middle that she had a 403b, not a 401k, but very similar. So she's got the maximum that she could afford going into that. Greg was able to max out his 401k to the maximum amount, and then they were still doing a very small amount to college savings for their grandchildren, and then obviously some to giving as well. So we really recommended, they wanted to give more to giving, but we suggested to them to consider legacy gifts rather than current gifting in order to protect their retirement. So this slide is really one that we work with our retirees to really smooth out volatility in their investment portfolios. So we've talked about the emergency reserves bucket there on the left, having 6 to 12 months worth of cash in a very protected, very safe account. We've also talked about that third bucket on the right, which is essentially their retirement funds. Most of the retirement funds are in 401ks and IRAs, 403bs, etc. But we haven't talked about this middle bucket, which is really a bucket which you can create yourselves, either through cash, making that a goal, or maybe even with some of your retirement funds. But the idea is you're going to create a very conservative bucket of between 12 to 24 months worth of living expenses, mostly in cash or in bonds, a conservative fixed income. And what we're going to do is have, again, that 1 to 2 years worth. And so what this sets up is really almost 3 years worth of funds that are in conservative or cash accounts to really alleviate any downturn in the market and really help protect you as you move into those retirement years. So that's one of our investment portfolio 401k tips. A couple of the others that come to mind are, again, talked about consolidating accounts for simplicity or better management. We've talked about in terms of the investments themselves. If you do have this previous slide where we have now an excess cash reserves, an emergency reserves, and the retirement funds, we actually can help you really avoid psychological or market timing or making decisions that are really based on emotional decisions. So it's much better to actually have your setup prior to, say, moving into retirement, where you're prevented from making market timing or emotional decisions. And then lastly, there is a little known provision out there called an in-service withdrawal option. It does allow 401k active participants over age 55 to actually roll over a portion of their funds into a traditional IRA while they are still working. So this gives you options for investing that maybe your 401k plan doesn't offer. And so that question, is your 401k plan right for you? Maybe it isn't as right for you at age 55 or older, and so you're really maybe moving it out of that into an IRA to basically set up a situation where it's more beneficial to you. What's also really important is as you basically move into your retirement or close to retirement years, you really do want to have your retirement really set up well. You can do that via a financial plan by consulting with a certified financial planner. Do it with your investment advisor. Certainly you've seen us throughout the case studies as always continuing the 401k savings deferral, and then again try practicing retirement for 1 or 2 years before retiring. So to kind of summarize our overall presentation and taking a look at the actual 401k itself, this is a slide which really answers the question, is your 401k plan right for you? And so some of the things you might take a look at in terms of whether it is right is taking a look at fees. Certainly fees vary from 401k plan to 401k plan, so that's something you'd want to take a look at and assess for yourself. Certainly we've talked about the employer match, a common theme running throughout the presentation. You really want to do the minimum necessary to get 100% of your employer match. And then in terms of actual investment flexibility and how your portfolio or 401k is invested, some 401k plans offer a very small amount of investment flexibility. Some plans offer quite a bit. And so again, whether it's right for you or not is to kind of take a look at it, have your advisor weigh in, and certainly get some maybe a second perspective on that from a knowledgeable individual. If it isn't right for you, there are options when changing jobs to maybe roll into an IRA that Rohan talked about earlier, or maybe leaving it where it was or moving it into the new 401k. So again, those are some questions to ask when you're going through this. And then lastly, as you get towards closer towards retirement, really taking a look at the fixed income options in your 401k plan is important. Many 401k plans actually do pretty well with younger participants that are in their growth years. They don't do as good a job for fixed income investments. There's usually only 1 or 2 or just a few options, and so that may be another reason to determine whether that 401k plan is right for you. So again, changes as you approach retirement are really important. Lastly, we really recommend that you review your plan options and investments with your investment advisor on an annual basis, if possible, and also if you obviously make any major changes to your job situation.
Thank you, Laurent. Really good tips there. That's officially the end of the presentation. We have a few minutes left for questions, so if you wish to submit a question, please type it into the questions box on your GoToMeeting control panel. We'll answer as many questions as possible, but if we don't get to your question specifically, we'll get back to you with a phone call or an email after the presentation.
Okay, great. Well, I think any questions? Nope, doesn't look like we have any questions. So we're actually getting close to out of time here. So we're just going to cover the next webinar, which is scheduled for September 2014. So we're taking a few months off here for the summer. Hopefully you guys, everybody has a good summer vacation plans. But the next one is set up for September 17th. And it's called Performance Momentum versus Fixed Allocations, What Every Investor Should Know. And so hopefully you can join us for that. You don't need to wait for our monthly webinar or letter to stay in touch. We update our website with new content regularly, and we post daily market updates on Twitter. Bonnie Bell has a blog focusing on career life coaching issues, and you can find that at careerlifecoaching.bellinvest.com. And as always, if you have a question about your portfolio, please don't hesitate to contact us by email or by phone. That basically is it for our presentation today. So thank you so much for joining us, and we hope you have a good rest of your week.